In this comprehensive video, we are going to pull back the curtain on our top 7 candlestick patterns, ranging from the most fundamental basics to highly sophisticated advanced formations. Our objective is not just to list these patterns, but to demonstrate exactly how you can utilize them in synergy with price action to identify high probability trading opportunities. Ultimately, you should view this entire session as a complete candlestick trading masterclass. Before we dive into the heart of the lesson, I want to share a quick note. If you are interested in receiving our free professional training, simply click the link provided in the description to find out more. It is entirely free of charge. With that housekeeping out of the way, let's get straight into the details. The fundamental nature of candlesticks. To start, what exactly are candlesticks? At their core, candlesticks are a streamlined and visually intuitive method for analyzing the historical price data of any given asset. Each individual candlestick acts as a snapshot, representing the price movement of that asset over a specific defined period of time. For instance, if you are analyzing a daily chart, a single candle on that screen accounts for the total price action of one full day. When looking at the chart, you will generally observe 2 distinct types of candles, green candles and red candles. A green candle is generated whenever the closing price ends up higher than the initial opening price. This visual cue serves as a direct indicator that, during that time frame, the buyers were significantly stronger than the sellers. Conversely, a red candle is formed when the closing price finishes lower than the opening price, signaling that the sellers successfully overpowered the buyers. The anatomy of a candle. The reason the vast majority of professional traders prefer candlesticks over other chart types is that they provide a much deeper and more nuanced understanding of price fluctuations. A standard candlestick is composed of 2 primary parts, the wicks, often referred to as shadows, and the body. The tip at the very end of the upper wick reveals the absolute highest price reached during that specific time interval. In the same way, the bottom tip of the lower wick points to the absolute lowest price recorded during that period. When we examine the candle body, the interpretation shifts slightly depending on the color. For green candles, the lower boundary of the body represents the opening price, while the upper boundary marks the closing price. On a red candle, the arrangement is reversed. The upper boundary of the body is the opening price, and the lower boundary is the closing price. Core Concept 1. Big body versus small body. Before we explore specific patterns, we must master a few underlying concepts. The first concept is the comparison between a big body and a small body. The physical size of a candle's body can tell you an incredible amount about the relative strength or weakness of market participants. Consider 2 different green candles. The first candle has a very large body with relatively tiny wicks. In this scenario, the price opened at the bottom, and while sellers initially tried to drive the price down, they were clearly weak. Buyers flooded in immediately, driving the price upward with massive momentum. Because they encountered almost no resistance from sellers, the price closed very near its high. This tells us buyers were in absolute control. On the second green candle, the narrative is quite different. The price opened and buyers did manage to push the price to a new high. However, at those peak levels, sellers stepped in with significant force and drove the price back down. The sellers were powerful enough to erase nearly all the gains, though the buyers managed to secure a close slightly above the open. In this case, buyers technically won, but the margin of power was negligible. As a general rule, when a candle's body is significantly larger than its wicks, it indicates that one side is firmly in control. When the body is small relative to the wicks, it suggests a fierce, undecided battle where neither side could gain the upper hand. Core Concept 2. The meaning of large wicks. The second concept involves identifying large wicks. Whenever you spot a disproportionately long wick extending above or below the candle body, it provides a powerful clue regarding future price action. If you see a large wick protruding from the top of the body, it is a sign that sellers are aggressively defending those price levels. For the price to move any higher, buyers would need to exert an extraordinary amount of effort to break through that selling pressure. Similarly, a large wick appearing below the candle body demonstrates that buyers are stepping in heavily at those lower levels. If sellers wish to continue pushing the market down, they must first overcome the massive buy wall represented by that wick. Keeping these concepts of bodies and wicks in mind is essential as we move into the actual patterns. Pattern 1. The bullish pin bar. Moving into our basic patterns, the first is the bullish pin bar. This is a potent reversal signal that hints at a potential move to the upside. A classic bullish pin bar is identified by 3 specific elements: a small green body, a very large wick extending below that body, and either a tiny or non-existent wick above the body. The psychology here is fascinating. The price opens, and sellers immediately attempt to crash the market. They succeed in pushing prices quite low, but those discounted prices trigger a flood of buy orders. The buyers are so much stronger that they push the price all the way back up past the opening point. When you see this form after a prolonged downward move, it suggests sellers have exhausted their energy and buyers are taking over. To trade this, we typically look for other confirmations first, but a standard entry would be placing a buy order just above the pin bar's high with a stop loss below the low, targeting the next major resistance level. Pattern 2. The bearish pin bar. The bearish pin bar is the exact mirror image of the bullish version. It is characterized by a red candle with a small body, a massive wick reaching upward, and little to no wick on the bottom. This pattern indicates a potential reversal to the downside. The psychology is straightforward. The market opens, and buyers initially drive the price higher, feeling optimistic. However, sellers eventually enter the fray with such aggression that they push the price back down, crossing below the opening price and closing near the lows. This indicates that sellers have successfully seized the advantage. If other market factors align, a trader might place a sell order below the low of this pin bar, keeping a stop loss safely above the top of the wick. Pattern 3. The doji. The doji is perhaps the most unique pattern because it does not provide a specific directional bias on its own. Instead, it represents a state of total equilibrium. A doji is defined by having roughly equal wicks on both the top and bottom, combined with an extremely small body where the open and close are nearly identical. This formation shows that buyers and sellers were locked in a highly competitive struggle, but in the end, they were perfectly matched. While a single doji might just indicate a brief pause in a move, seeing several dojis in a row suggests a massive battle is taking place. Usually, once this period of indecision ends, the price will erupt in a violent breakout in one direction or the other. Pattern 4. The bullish engulfing bar. Now we move into intermediate territory with two candle patterns. The bullish engulfing bar occurs when a green candle completely swallows the red candle that came before it. Specifically, the green candle's high is higher than the previous high, and its low is lower than the previous low. The story behind this is that sellers were initially in control during the red candle. When the next candle opened, they even tried to push the price lower, breaking the previous low. However, buyers suddenly intervened with overwhelming force, driving the price all the way back up and beyond the previous candle's high. This proves that buyers covered a much greater distance and are now the dominant force. For an entry, traders often buy as the price breaks the high of this green engulfing candle, placing a stop loss below its low. Pattern 5. The bearish engulfing bar. The bearish engulfing bar is a two-candle formation where a large red candle completely encompasses the preceding green candle. It starts with buyers appearing to be in control as they form a green candle. When the next candle opens, they attempt to push even higher, breaking the previous high. However, sellers recognize these highs as a prime opportunity to short, and their selling pressure is so intense that they drive the price down past the low of the previous candle. Since the sellers moved the price much further than the buyers did, they have effectively hijacked control of the market. A sell trade can be initiated below the low of this red candle, with a stop loss positioned above its high. Pattern 6. The Morning Star, Advanced. Entering our advanced section, we have the Morning Star, a three-candle bullish reversal pattern. It begins with a strong, large-bodied red candle, showing sellers are in full control. The second candle is a small doji or pin bar, which indicates that buyers are starting to push back and sellers are losing their grip. The third candle is a large green candle that breaks above the high of the middle doji. The strength of this reversal is determined by the size of this third candle. If it is larger than the first red candle, the probability of a successful reversal is very high. This sequence shows a complete transition from seller dominance to a stalemate, and finally to buyer control. To trade this, you would place a buy order above the high of the green candle and a stop loss below the middle doji. Pattern 7. The Evening Star, Advanced. The Evening Star is the bearish equivalent of the Morning Star and also utilizes three candles. It begins with a strong green candle, buyer control, followed by a small doji, tug of war, and concludes with a large red candle, seller victory. This shows the clear progression of a trend exhausting itself and being overtaken by the opposite side. To enter a sell trade using this pattern, You would place your order below the low of the third red candle and keep your stop loss protected above the high of the doji. Mastering price action confluence. Understanding these 7 patterns is a great start, but to truly excel, you must learn to combine them with price action concepts like support, resistance, and trend lines. For example, imagine the price is in a downtrend but approaches a previously identified support level. As the price nears that level, you notice the candles getting smaller, a sign of fading momentum. If a morning star pattern then forms exactly on that support line, it provides a very high probability buy signal. Another example involves trend lines. If you have a solid descending trend line and the price approaches it, you wait for a signal. If a bearish engulfing candle forms right as the price touches that trend line, it confirms that the trend line is acting as strong resistance, offering a prime shorting opportunity. Final thoughts and next steps. Always remember that candlestick patterns should not be traded in a vacuum. On their own, they are just shapes. However, when you combine them with key levels and market structure, they become a powerful trading system. I hope you found this masterclass informative and that it helps you refine your trading strategy. If you did, please make sure to hit the like button and subscribe so you never miss our future sessions. Don't forget to visit our website for further free training. I will see you in the next video.